Hello and welcome everyone to another video. Welcome to my channel. This video, as you can see the title, it's for the beginners. Okay, this would be the series, one of the videos in the series called as Ultimate Forex Trading Guide for Forex Beginners. Right, so if you are an intermediate trader or an advanced trader, I would suggest that you skip this one particular video. This is for the extreme beginners, guys, because if you are like, at least you understand the market, you understand what is the Forex market, you understand the pairs, you understand the orders, this is not for you. And there is a whole community for me, which I have created for the Forex beginners. The link is in the description. If you want to join there, I would be sharing much more value and ideas of how you can develop as a beginner trader. Okay, so do not miss that. Without further ado, I want to show you guys a lot of things, so let's go. Before I get into the nitty-gritty of the whole idea of the Forex market, I want to go down memory lane, because you have to understand the history of it. So this gold standard monetary system, okay, which we had before, even in the ancient times, or during the barter system times, whereas we used to exchange our currencies in terms of golds and silvers, right? In Arabic, if I would call it, it's called as dinar and dirham. So this gold monetary system was implemented in 1876, before the gold standard was created. Okay, countries would commonly use gold and silver as a method of international payment. Okay, so previously every international transaction was taken care of in terms of gold or silver. Okay, a country that uses the gold standard sets a fixed price for gold and buys and sells gold at that price. That fixed price issued to determine the value of the currency of that particular country. Okay, so the example, in the era of gold standard system, before World War I, 1 ounce of gold was equal to $20.06. You can see the difference now, right? At that particular time, what was the price of gold and what's the price of gold now? So 1 ounce is equal to 28.35 grams to the people of the Eastern Hemisphere, who do not use ounces, right? We use kilos and grams. So Britain stopped using the gold standard in 1931, and that's when I guess the Bank of England and everything was formed, and the paper currency came into play. And then US abandoned the system in 1971. Now, Bretton Woods Agreement, if you guys have no idea about this, even if you are not a beginner, if you are an advanced trader, and if you are an intermediate one, but if you do not know this, you should go and educate yourself about this thing. It's very, very interesting. It opens up a lot of things about the capitalistic market and the world economy as well. And what impact did this agreement have on the value system of the world? Okay, so before the end of the World War II, the Allied nations believed that there would be a need to set up a new financial system. Okay, so around 1944, approximately 44 countries sent their delegations to a conference in Bretton Woods, New Hampshire, to lay over what would be called as the Bretton Woods Agreement and the system of international monetary management. In simpler terms, the Bretton Woods led to a formation of a fixed exchange rates of a currency. Okay, and the US dollar became the actual standard of transactions, meaning the gold standard was taken over by the US dollar, meaning the paper currency, and it led to the creation of International Monetary Fund and the International Bank of Reconstruction and Development. So a little trip down the memory lane. All right, let's begin with the actual course. So who are the major players in this? First one, as you can see, are the banks. To be precise, these are the central banks of every single country. Okay, they are the ones who hold the most paper money, or gold reserves of the country. So they have, of course, the power to move the markets and lend their money to commercial banks and retail banks. The next one are the forex brokers, hedge funds, and then commercial companies. And the third one, of course, is you and me, the retail traders who have no idea what the hell is going on. So these are the major players, these are the intermediate players. Of course, these are also would be in the category of retail funds, retail money, right? But then of course they are above the normal retail traders, so they are in the middle. So you should know who you are competing with, right? As a retail trader, you should know you are competing with these three and then the commercial banks as well, and these are also competing with one another, right? But in a psychological point of view, you as a trader, you are competing against yourself in the market. You will never master the market, but you can master yourself. So keep that in mind as a psychological cookie. So what are the forex market hours? You should make sure that, you know, once you go to trading view, okay, you set your time to -5 UTC, which is the Eastern Standard Time in New York. All right, and it changes according to the daylight saving time. So during the summer times it will be -4. Over here, if you can see, there are 4 sessions, right? London, New York, Sydney and Tokyo, according to the New York Standard Time, Eastern Standard Time, which meaning the New York time. So the forex market, it actually begins 5 p.m. right, from 5 p.m. in the evening to 5 p.m. the other day. Suppose this is Sunday, okay, so Sunday 5 p.m. market will start, and then Monday 5 p.m. the market will close of that particular day. All right, and we have London starting from 2 a.m. all right, over here it's shown 3 because of the daylight saving time. It starts from 2 a.m. all the way up to 12, and then New York starts from actually the forex market starts from 7 all the way up till 5 p.m. right? But the equities, you know, the stock exchange and everything, it starts from 9:30 a.m. New York time. So during this particular window, if you can see the window from 7 till 3 p.m. New York time, you'll see the most volatility in the market because a lot of liquidity is injected into the market due to the fact that 2 countries or 2 sessions are competing with each other, London and New York. You can see, as you know, that London market is also a really large market in terms of you know, liquidity. You don't want to you want to make sure that you do not, you know, trade the Asian session, because usually it's a lot of time it's a consolidating market, meaning the market is just moving up and down and there is no smooth direction. So from 2 a.m. New York time all the way up to 11:30 would be the time window for a lot of opportunities, and then after 12, between 12 and 1:30 p.m. you don't want to touch the market, you want to stay away because of the lunch time, and then after 1:30 you can look for another trade during the 3:30 time window. That's it. After that, do not touch the market. Okay, so make sure you understand the market hours. What is a base currency? You can see a lot of times we have you know, Euro USD, GBP USD and everything, but what does it mean? What these 2 things mean? The first one, the first currency that appears in a currency pair over here is Euro USD. In Euro USD we have euro. It's called as the base currency. Okay, so the first currency will always be the base currency. What is a quote currency? That would be the second currency that appears in a currency pair. Over here, Euro USD, we have USD as the quote currency. Okay, so euro is the base and then the US dollar is the quote currency in this pair. Okay, what's the use of it? Like, what's the purpose? It tells you how much it costs actually in quote currency to buy one base currency. So how much will that quote currency will cost to buy this currency in terms of Euro USD? Example, Euro USD at $1.3, meaning 1 euro will cost $1.3 to buy. All right, so the different types of currency pairs, we have major currency pairs, cross currency and exotic currency pairs. Let's just go into it. Major currencies, why do we call them major currencies? Because we have the Papa US dollar involved in all these currencies. Euro USD, GBP USD, USD CAD meaning the Canadian dollar, USD JPY meaning the Japanese yen, USD CHF and AUD USD, as well as we have NZD USD. Okay, we have these currencies. Why? Because US dollar is the international currency. That's why we have major transactions happening with US dollar along with these major countries. All these countries are first world countries, and their currencies are also expensive, so that's why these are called as major currencies, and they have the most volatility as well in terms of liquidity. So what are cross currency pairs? It refers to the currency pairs which are non-US dollar. Okay, the currency pairs over here, everyone has US dollar, but here we have non-US dollar currencies. Okay, so euro cross, meaning the currencies which are traded against the euro. So euro GBP, euro AUD, and euro NZD. AUD is the Australian dollar, NZD is the New Zealand dollar. Pound crosses, GBP JPY, pound meaning the Great Britain pound, right? So GBP JPY, it's trading against the Japanese yen, GBP trading against the Australian dollar, GBP trading against the New Zealand dollar, right? And then we have yen crosses, Australian dollar against JPY, which is the Japanese yen, New Zealand dollar against the Japanese yen, and then the GBP, which is pound, against the Japanese yen. All right, these are called as what? The cross currency pairs. So few we have over here. We have the exotic currency pairs. Okay, so exotic pairs are actually the ones which are traded against one major currency which is traded against one currency which is from a developing country. Okay, so in this case this would be USD Mexican peso MXN, or euro, which is from a major currency, against Turkish lira, which is a developing country, INR Indian rupees against the GBP, right? These are called as exotic pairs. Now into the understanding of the mechanics of the market. What is a pip? You would be listening to a lot of these, like euro made 10 pip movement, or GBP made 50 pips movement. What does pip stands for? It stands for percentage in point. Okay, it's a measure of a change in value in a currency pair. It's the fourth decimal place. If it moves 1 point, that means that's a movement of 1 pip. Okay, so suppose in euro USD, if euro USD moves from 1.1050 to 1.1051, right? You see the fourth decimal, that's the movement of 1 pip, meaning euro rose 1 pip against the US dollar, right? So if this in this one, if it was 2, like from 50 to 52, this would be a movement of 2 pips. Okay, let me give you an example. This is another example actually. Okay, so if euro moves from 1.3500 to 1.3505, what would be the, how many pips is that? It's an increase of 5 pips, 500 to 505, right? The movement of the fourth decimal. Okay, so we have 1, 2, 3 and 4. This one is called as the fraction of a pip, the fifth decimal. So for now, let this one be. Okay, I just wanted to put it out there because you have to have an understanding that sometimes you will see 5 decimals as well, so don't get confused. Okay, this one is a 0.1 pip move over here. This is 1 pip. Okay, because this is the fourth decimal. Okay, this is the third decimal after the point, right? Third digit, which is 10 pip. So suppose over here I have an example, 1.2468 from 1.2469 is 1 pip. But if we have 1.2468 which moves from all the way to 1.2478, that's a movement of 10 pip, right? Now here we have a movement of 100 pip. So if this is a movement of 100 pip, which one of these numbers you think would have changed? This one right here, correct? We have decimal point first digit, second digit. The second digit is 100 pip, third digit is 10 pip, first digit is 1 pip. Okay, so if we move from 1.2468 to 1.24568, that's 100 pips move, which is a lot in the forex market. Here is one again one more example of what is a 1 pip movement. So you'll see on your Meta 5 or trading view something like this: euro trading against the US dollar. Okay, 1.1150. We have 0 over here, but we have 1 over here, which means an increase of 1 pip. Okay, so euro moved up 1 pip against the US dollar. Okay, and this is again the depiction of 50 pips movement from 3400 to 1.3350. Okay, there's a minus. So now JPY pairs are special in terms of what? In terms of normal pairs, right, we have the 4th decimal, right, which moves, so we have the pip movement, right, but in this one we have the 2nd decimal place. Pip moves from 100.10 to 100.15. That's an increase of 5 pips right here. We don't have 3rd or 4th decimal, right? And this is another example. You can see it's the same one. It's a pipette is the actual 5th decimal, okay, which I spoke of in the beginning. So also known as the fractional pip, which is the 1/10 of a pip. This is too much actually for you to understand, so you can just skip over this, or else if you want to read all about this, you can go to babypips.com and then study it in much more details. Okay, this is the pipette in terms of USD JPY. This is the 3rd decimal. In terms of Euro USD or any other pair, it's the 5th decimal. Okay, this is another example of a pipette, so you can just go over it yourself. What is leverage in trading? Okay, the ability to trade a larger amount of money relative to your account size. It's also called as the double-edged sword. Why is it called as the double-edged sword? Because if it's helpful to you, it's also really dangerous for you as well. If you have higher leverage in terms of the size of your account, there is a possibility that you will make a lot of money, but there is also a possibility that you will lose the same amount of money as well. Okay, how it works actually? Leverage is expressed as ratio. Like in particular brokers, it depends. So it starts from 1:1, 1:10, 1:50, 1:100, 1:200, 300, 500. Few brokers also offer 1:2000, you know, the leverage. What does it mean actually? So every $1, okay, you have the leverage of buying $10 worth of any instrument. Okay, so $1 converts to $10 in your account. So if you have $1,000 in your trading account and you use 1:100 leverage, you can trade positions worth how much? 100,000 US dollars. So 1,000, okay, into 100, that's how much? 100,000. Example, without leverage, 1,000 account can only trade $1,000 worth of currency. But if you have a leverage of 1:100, a $1,000 account can trade up to $100,000 worth of currency. Risks. While leverage increases the potential of profit, it also magnifies losses. A small unfavorable price move could result in significant losses. So that's what leverage is. Okay, that's why risk management comes into play, and that risk management and technical analysis is a separate topic for a separate video. I just want you to go through all these things once and for all. Okay, what are lots in forex? So there are multiple lots. So I'll give you a normal example. You know, when you go buy something from any particular market, suppose you want to buy shoes. Okay, you open up a shop, you want to buy you know, a lot of pairs of shoes. You'll go to a distributor, right? You will buy suppose you want to buy 100 pairs. Okay, that's what all you know, forex is as well. It's as, you know, precise and simple as that. If you want to buy one lot of euro or any currency, one lot, One standard lot equals to 100,000 units of that particular currency. So suppose you're buying euro dollar, okay, you're buying euro against your US dollar, and you want to buy one standard lot of euro. It will amount to 100,000 units of euro. Okay, mini is equal to 0.10, meaning 10,000 units. Micro lot is 1,000 units, which is 0.01, and nano lot is 0.001, which means 100 units. Okay, so all these things, the more lots you purchase, okay, the higher the risk. The lower you go, the lower the risk you have. Understood? So what is a pip value? We were speaking of pips over here, right? Here we had the understanding of pips. This one right here, this is USD JPY. This one right here is also a pip, 50 pips move. Okay, so this one pip, okay, this one pip, this 50 to 51, what's the actual value of it? How much it increases or decreases in value? Let me show you, because the understanding of that is also crucial for you to begin your trading journey. Okay, if you do not understand it, you're gonna make a lot of losses, just like I did in my earlier days. So how much one pip is worth? It depends on two things. The lot size. What is the lot size? Here, this is the size of your lot. If you are trading one lot, or one mini lot, if you're trading one micro lot, etc. Okay, and the second one is the quote currency. This is the pip value in terms of the understanding. Okay, I'll just come back to it later on. One standard lot, okay, if price, which equal to 100,000 units, if price moves one pip, from in the last scenario we saw, if it moves from 50 to 51, that's a movement of $10 in a standard lot. Okay, in a mini lot, which is 10,000 units, the movement is equal to one pip is equal to $1 in a mini lot. In a micro lot, it decreases to $0.1 worth of value per pip. Okay, only if your quote currency is US dollar, like Euro USD, GBP USD, and AUD USD. This one applies this $10 move per pip on a standard lot. It applies to currencies which have their quote currency as US dollar. Okay, meaning US dollar comes the second one, here second, here second. Okay, number two is the quote currency. If the quote currency is euro, then the standard lot is 10 euro. Okay, the same principle, it's just different currencies. Example, you trade euro US dollar and then buy 2.3 standard lots. How much is the pip per value? That's $23, right? This is $2. Why? Because two lots is equal to 20, and then 0.3 is $3. Another example, you trade GBP AUD and buy 5.5 mini lots. How much is the pip value per pip? It's 5.5 AUD, right? Over here, the currency, quote currency we have AUD, that's why the movement is also calculated in AUD. Okay, what is a spread? Okay, now this one is a really crucial topic. So if you are bored or distracted, snap out of it once again and then just pay attention to this, because this is really important. Difference between the bid and ask price. Okay, that's as simple as anything can get be. Base currency, right? The first one, this is the quote currency. Okay, the difference at times, if you'll open up the MT4 or MT5, you'll see the bid price and ask price both are different. Bid price is equal to the price where you sell, and then the ask price is where the you can buy. Okay, so this difference between 8.9 to 9.1, which is the difference of 2 pips, that's the spread. So if you open up one lot, okay, you might open up at a minus position in a minus, which means it will be $20 or something, because one pip at one standard lot is equal to $10. right? You can see over here, this is the sell, which is the bid price, okay, 2741, this is GBP USD, and over here 2744, right? So that's it, that's all the difference is. Sometimes it increases, sometimes it decreases. The spreads are always subject to the market volatility. Suppose there is very less volatility in the market, you will see a lot of these spreads will be increased, okay? But if you'll see the market, which is around the time of New York market or London market, at that time these values will be lower in terms of relativity, okay? So this is the sell, this is the MT5 terminal, okay? This is the sell, which means the bid price, and this is the ask, which means the buy price, okay? Why spread matters? Spread is equal to the transaction cost, meaning if you're buying from your broker, there is a charge between the buy and sell price which the broker takes, okay? That's the spread, that's how the brokers make money. The higher the spread, the higher your transaction cost, and the lower the spread, the lower your transaction cost, okay? Let's come back to the basics of long position and short positions. Buy when you expect value to raise, and then sell when you expect value to fall, of course. So suppose this is your entry price, okay? You believe that euro coming from this particular point, euro is going to go up, so you want to buy at this price right here at this place, and then you put your take profit over here, and then put your stop loss below. If you do not know what this is, it's coming up in the next few slides, okay? And then in a bear market, like in my previous videos I've shown you, you want to sell in a bear market, right? And then you put your stop loss above, and then you take profit below, like over here I have depicted. You long or buy entry from here, okay, anticipating that price will move up, okay? Take profit order is here. This is trading view, so I'll give you a tutorial about trading view in the coming videos as well. Here is your stop loss, this is the buy position, and this is the sell position, total opposite. This is your stop loss above, this is your short sell entry, and then this is your take profit, meaning when you anticipate that market will go below, you just place a short position, and then when you anticipate the market will go up, you place a buy position. All right, different types of forex orders, right? And these orders fall into two buckets: market order, an order instantly executed against the price that your broker has provided, and then the another one is pending order, an order to be executed at a later time at the price you specify. Okay, let me just show you. Market order, buy market order, an order to buy at the current price, current market price, no matter what, guaranteed to enter at a trade. That's the pro. And then during the time of news, there are major news which come up, you might get slippage. I'll explain what slippage is in my upcoming videos, and then I'll explain how to read the news as well in my upcoming videos. What is the limit order? Okay, current price, suppose, of gold is $2,000 US, okay? You want to buy gold at a lower price, okay? You expect gold to fall at $1,950, so you place a limit order, a buy limit order, anticipating that price will come down to your order, and then it will move forward, right? Vice versa for sell limit orders. You see that price of gold is at around $2,000 US, okay? And then you anticipate that gold will come back up to a price of $2,100, and then you are anticipating once again that it will fall from there, so you place a limit order and wait for your order to be filled, and then it delivers. And these are all automated, so you don't have to worry about whether your order will be filled or not. Stop orders, these are the orders where, suppose your current price is $19,000 US, okay, any particular asset, it can be gold or anything, okay? You want to be a buyer, but you don't know whether market will go up above or will it come back down. So in anticipation that once market crosses over a particular price level, you want to be a buyer and you do not want to miss the move, and you want to buy on strength, okay? then you place a buy stop order. These are called as stop orders. So you'll keep your order, which can be called as the limit order, but at the opposite direction, meaning the price is here and then you want to buy higher, but anticipating that there will be more strength into the markets and you don't want to miss the move. So you place a buy stop order at 20,100. Okay, same goes vice versa for a sell order. You believe that once market crosses the range of 18,950, any particular asset, you want to be a seller and you don't want to miss this one particular move. So what do? You place a sell stop at this particular price, and then you wait for market to crash, right, fall down, and then take your order in and keep on continuing. And this was it for the Forex beginner series. In this video I didn't show you much, but I showed you the mechanics and the understanding of the markets, of what are the types of orders, what are pips, what is a Forex market. And in the coming videos there will be part 2 and 3 as well, where you will understand the the technical sides, and then the fundamental analysis side, as well as the risk management of how and what to do in the markets and what to do with your money. All right, so I hope you enjoyed this video. Do like and comment any particular questions you have, and then I'll be sharing the link in the description for the beginners Telegram group. You can join and ask me questions there as well. All right, so until next time, next video, good luck and good trading.